Hello everybody, welcome to my forex trading course, lesson 17. Today we shall be looking at time frames and top-down analysis. In forex trading, your time frame is very important, very important. And there's what we call top-down analysis. So it is very important. That is what we are looking at today. Time frames and top-down analysis. So let's get started. As a price action trader, your primary time frame is the 1 hour, the 4 hours, and the daily time frame. Price action works on bigger time frames. If you try to trade pin bars or engulfing bars on the 5-minute time frame, you will lose your money because there is a lot of noise on smaller time frames, and the market will generate a lot of false signals because of the hard battle between the bears and the bulls. When we say time frames, what do we mean by time frames? Time frame is simply just the time or period it takes a price to complete. So the time or period it takes price to complete is what we call time frame. And there are different types of time frame. You have the 1 minute, you have the 5 minutes, you have the 15 minutes, you have the 30 minutes, 1 hour, you have the 4 hours, you have the 8 hours. That's on TradingView, you will see 8 hours, but on MetaTrader 4 you will not see 8 hours. So we have the daily time frames, we have the weekly time frame, and we have the monthly time frame. Besides, there is no successful price action trader who focuses on one time frame to analyze his chart. Maybe you have heard of the term top-down analysis, which means to begin with bigger time frame to get the bigger picture, and then you switch to the smaller one to decide whether to buy or to sell the market. So when we say 1 minute time frame, 1 minute time frame means that it takes 1 minute for price to complete. That means it opens and closes in 1 minute. So after 1 minute, another price will start to form. As if you are using candlestick chart. So a candlestick will open in 1 minute. If you are using 1 hour time frame, so it takes 1 hour for a candlestick to be formed. So it opens and closes in 1 hour. So after 1 hour, another one will open, and it will take 1 hour to form. Let's say you want to trade the 4-hour chart. You have to look at the weekly chart first and then the daily chart. If the weekly and the daily chart analysis align with the 4-hour chart, you can then take your trading decision. And if you want to trade the 1-hour chart, you have to look at the daily chart first. This is a critical step to do as a price action trader, because this will help you avoid low probability trading setups, and it will allow you to stay focused on high probability price action signals. Through the top-down analysis, we always start with the bigger time frame, and we look to gather the following information. Number 1, the most important support and resistance levels. You have to know the most important support and resistance level. These areas represent turning points in the market. If you can identify them on the weekly chart, you will know what is going to happen and when the price approaches these levels on the 4 hours chart. Something happened yesterday on gold. A lot of traders were trapped yesterday on gold. Why? Because they were using smaller time frame. They were expecting price to fall. But what happened? Price started going up. Why? Because the weekly time frame, there was a breakout on the weekly time frame which I was trading weeks ago. There was already a breakout of a falling wedge. So the breakout resumed yesterday, and a lot of traders were trapped. They made losses. Why? Because they didn't use the weekly time frame. They were using maybe 1 hour, only smaller time frame. Because the bigger time frames takes precedence over the smaller time frames. So you will decide either to buy or to sell, or to ignore the signal you get when you use bigger time frame. So when you use the bigger time frame, you get the bigger picture of what is happening in the market. Another one is the market structure. The weekly analysis will help you identify if the market is trending up or down, or it is ranging or choppy. So when you use the bigger time frame, it will help you to know the market structure. You will know whether it's a trending market or ranging market or a choppy market. So you will know what is happening. In general, you will know what the big investors are doing. When you look at the bigger time frames, you will see the exact thing they are doing. And the bigger time frame drags the smaller time frame. So whatever is happening in the smaller time frame, no matter how long, the bigger time frame will still take precedence. For example, if the bigger time frame is telling you to buy and the smaller time frame is telling you to sell, what do? It's better you wait for the smaller time frame to tell you to buy, so it can be in line with the bigger time frame. Because if you go and sell, if you sell, yes, you may make profit, but you may end up losing, because the bigger time frame may just prevail. In fact, it will prevail, and you may get trapped. You may escape it. So the third one is the previous candle. When you look at the bigger time frame, it helps you to get the previous candle. You check the previous candle. The last candle on the weekly time frame or on the weekly chart is important, because it tells us what happens during a week, and it provides us with valuable information about the future market move. So when you check the weekly time frame, the previous candle will tell you what has happened during the week. When you identify these points using the weekly chart, you can now move to the daily chart or the 4 hours chart and try to gather information such as the market condition, as what the market is doing on the 4 hours time frame. Is it trending up or down? Is it ranging, or is it a choppy market? So you have to determine this. The second one, what are the most important key levels on the 4 hours or the daily time frame? This could be support and resistance, supply and demand areas, trend lines. So you have to get the key areas, the most important key levels, using bigger time frame, so that when By the time you now get there, you know what to do in the smaller time frame. The third one is the price action signal. So a candlestick pattern that will provide you with a signal to buy or short the market. So this is very important when you look at the bigger time frame. So it helps you to know the price, to get the actual price action signal. This could be a pin bar, a governing bar, or an inside bar. Could be any of these. So the bigger time frame helps you to get the accurate signal. It is more reliable using the bigger time frame than the smaller time frame. So you combine everything and you make sure they align before you go for a trade, before you take your decision. So in the next class, I will tell you how to use the trading strategies, how to trade using top-down analysis. So today I just explained their meaning. So see you in the next class. If you are new to this channel, make sure you subscribe, like, and click the notification button so that when I post another video, you get it. And if you want my other lessons, you can click in the description, you get it. You get the link to the other lessons that we have treated. So see you in the next video.